Hello again. We are reporting back on the month of May 2023. Quite a volatile month both locally and globally. We'll get into those details in a few minutes. So a lot of news coming out. The biggest economy in the world being the US. First one, they increased their interest rates by 0.25%. This brings now the total increase to 5% that they've had since they started raising rates to try and quell inflation in the US. This will slow down that economy even further. The other concern from the US has been the government debt ceiling, and this is just a limit that's been in place that stops the government spending once they hit a certain limit, and that, if not resolved, could even result in possible default by the US on some of their debt. And this was a major concern, something that needed to be sorted out. And then lastly, commodity prices were softer during the month of May, and this pretty much on the back of these concerns coming out of the US. And the Chinese economy, although it has been improving, hadn't improved as much as some economists were expecting. Another point we'd be amiss to ignore was how much artificial intelligence or interest in that was driving stock markets around the world. The Nasdaq, the US technology stock market, was up strongly, almost 6% for the month, while the rest of the market, if you exclude tech, was either flat or even slightly negative for the month of May. Nvidia, a large tech stock that produces microchips that are used by artificial intelligence, went through the $1 trillion mark in terms of the size of that company. If we have a look at the valuation, in other words, its share price compared to its earnings, it's at extremely expensive levels, something you typically see when you have a hype-driven market happening. There's an old adage that goes, sell in May and go away, and that was definitely the case for the South African stock market for the month of May. One never knows these things in advance, but if we have a look at our markets, a lot of negativity both in the stock market and in the bond market, and a lot of that coming on the back of really South African own goals in terms of how the government was handling its relationship with Russia, the Lady R inquiry that's still ongoing, how the US ambassador had reacted to this. In addition to that, the load shedding situation was at some of its worst points ever. And all of these things just adding to the negativity around South Africa, and a lot of sentiment driven selling on the back of that during the month of May. The rand weakened dramatically, got to almost 20 rand to the dollar, and our stock market and bond markets were also a lot weaker for the month. So if we have a look at the returns during the month of May, you can see a lot of green there, but actually it's hiding something. The South African markets are the only ones that have shown some negatives, but if you back out the effect of the rand weakening during the month, the international markets were also slightly down, most of them for the month, if you looked at them in hard currency. The shorter term returns, the offshore investments for South African investors definitely being rewarded, but again, mostly because of our currency weakening. If one looks over the longer term, however, still growth assets giving you the best returns, definitely over 3 years, but even over the 10 years plus, real returns of close to 5% in South African equities, and closer to double that on your global equities, which are up quite strongly over the longer term. So if we have a look at how our firstly South African models have performed, we can see over the last year some pleasing returns. Remember, if it's shaded in green, that means we've outperformed our peer groups, and so all the models over the 1 year period outperforming quite nicely. If we have a look at the 3-year returns, particularly pleasing. Those are a number of double-digit returns over the different longer-term models. Very pleasing to see, and again, all outperformance of peer groups. And then over the 5 and since inception, which for some of them is even more than 10-year periods, over the 5 years, 1 or 2 of the models that have underperformed inflation, underperformed their peer groups, but seeing that if we look over longer periods, actually have made that up, and since inception all the models still nicely ahead of their peer groups. So let's have a look at our global strategies. The first lot are in US dollars, and here you can see their returns going back now almost 7 years. Over the last year, our growth strategy underperformed its peers slightly, but not something we're too concerned about. If we have a look at the longer term returns, still nicely ahead of their peers over all periods. The other set of global models that we run are UK or sterling based models, and you can see here these strategies haven't been going for as long, only just over a year and a half track record now. And you can see over the last year some underperformance, but again, since inception, having more than made up for that. And our focus on these models is really more a long-term focus as this track record builds. So let's have a look at what drove the markets, and then we can make some comments about what we expect from them into the future. So this first graph just shows you different styles of investing and how they performed so far year to date, and we've taken them across a number of different markets, across the global markets, across the US, the UK, South Africa. And we can see here the growth strategies were up strongly, while the value strategies were either negative or much lower in return, meaning that people are putting more emphasis on future earnings that haven't arrived yet than they are on current earnings. And then on the right hand side, you can see the difference in the three markets in the US, the S&P 500, the largest 500 stocks in the US. Compare that to the NASDAQ, which is the technology index, and then compare that to the old Dow Jones Industrial Average, which is just industrial companies. And you can see you just needed to be in tech for the so far year to date. So on the back of that, let's have a look. This next graph just shows you Nvidia, which I referenced earlier on, how that stock has grown so far this year, up dramatically. And importantly, its valuation now is sitting at over 200, meaning that if you were wanting to be repaid by the earnings of that company, it would take 200 years at the current earnings level. So a sign that company is quite expensive. And then on the right, I think it's a graph we've shown in the past before, just showing you the orange section is that the market is just being driven so far this year by 10 companies, and most of those 10 companies are technology stocks. Not something we think is a good sign going into the future, that the market is again being driven by a very small percentage of the market, which does pose risks for future growth. So in the month of May, we saw the South African markets, bond, equities, property, all taking a lot of pain. And those were on the back of own goals that I mentioned in the introduction. One of those is around load shedding, and there's some more graphs in the written version of this that you can go and have a look at on the future impacts we're expecting around load shedding. Suffice to say that there is a lot being done that we think load shedding is going to be a thing of the past in a number of years, not because Eskom has solved all its problems, but more because the private sector is actually taking control and sorting these things out themselves. In addition to that, we've seen our bond market get to really low levels on the back of all these own goals in May, and in fact, as at the time of recording, which is almost halfway into the month of June, we are seeing that a lot of the bond market and equity market negatives we saw in May have actually turned around subsequent to that, and we think longer term we may see more of that if we see improvements around these own goals that our government keeps scoring. So I'm going to end with some comments around the South African Rand, and this graph shows you some research done by Signia Asset Management, and there's three lines on this graph. The orange and darker blue line just show emerging market currencies versus developed market currencies, emerging markets being the darker blue one, and then the shaded area being the South African Rand to the US dollar. And you can see up until November last year that emerging market currencies moved pretty much in sync with developed market currencies, but that link broke out towards the end of last year. And then in addition to that, the South African currency was traditionally moving in line with emerging market currencies, even though there was a gap between them. But that really expanded in April and May of this year. And that was on the back of the own goals that I spoke around earlier. One that I didn't mention though was also the whole handling of President Putin potentially coming to South Africa for the BRICS summit. A lot of negativity around that. But something that is sure in markets. When things are driven on a lot of hype and a lot of speculation, those things can reverse very quickly. So even though we saw the Rand weaken a lot in May, we've actually seen so far up a couple of weeks into June, we've actually seen a lot of that reverse. Just in 1 week, the Rand strengthened by over a Rand to the dollar. So speculative movements in valuations can turn around very quickly, and this is something we have to caution against with our clients' portfolios. So having a look at when markets are driven by speculation or uncertainties that have a lot of unknowns in them, it's not usually a good time to make investment decisions one way or the other. And we saw that with the Rand. We've seen it with artificial intelligence. A lot of that has turned around in the last couple of weeks. But the longer term strategies remain the same. Have a diversified portfolio that has exposure around the world in good companies, and balance that out with different asset classes. And that's what leads to those long-term outperformances that we saw when we looked at our model portfolios earlier. So while there's many changing things in the world, something that we have just launched just recently is we have opened an office in Nelspruit in Mpumalanga of South Africa. We've added a new team member, Jasper, to our team up there, and one of our local team members is going to be working with him. And we're looking forward to working with a number of clients in the Mpumalanga area. Steve and myself were up there just recently for the launch. It was great to meet the people, and we look forward to seeing the Corewell footprint grow there and adding to their financial lives by giving them good advice. For the rest of you, it's good catching up. If you've got questions, as always, please give us a call. While the world is very up and down, we are confident in our ability to be able to give you good advice that actually in the longer term will add value to your portfolios.